And now I'm going to go to Rushanara, please.
Hi there. So I'm going to focus my questions also primarily on Connor and Barney, but if others do want to come in, please do raise your hand. So Connor, just picking up on some of the things you've said, could you just talk us through what your members are saying to you in terms of the implications of the deal, recognizing that, of course, people are glad there is a deal and lots of preparation and have been made, and this is within the realm of what was expected. And do you see, are they talking about fragmentation of the financial services sector? And you talked about market access. How does it feel on the ground in terms of members and what they are kind of grappling with and what they want to see going forward?
Sure. So I guess the first point I would reiterate is the benefit of not being surprised by this deal and understanding what would not be covered in the TCA and what would be covered. And I think because we landed in a spot that we had generally predicted for financial services, it meant that, you know, since 2016, 2017, financial service entities based in the UK could plan on effectively a worst case scenario on a basis where there wasn't any further provisions given for market access or equivalence. And to a large extent, that's what they've done. And there's a couple of points I'd add on top of that. The measures that have been put in place, and I'm quoting words from Andrew Bailey in a similar committee hearing last week, the measures put in place by both sides, effectively the equivalence determinations for clearing and settlement, they were put in place to ensure there wasn't any consequential financial stability or instability as a result of the UK leaving the single market. And I think we can say, you know, job well done on that particular component. What will not be covered and has not been covered by separate or ancillary provisions is measures to stop market fragmentation or market stability. So that has effectively begun to happen. We've seen some EU shares that would have naturally had a home in the UK now being moved to EU venues. This has been reported in the FT over the last 48 hours, about 6 billion of EU shares have moved back to the EU. Is that likely to flow back to the UK? We don't know. Was it predictable, and were these firms prepared for it? Yes, to a large extent, they absolutely were. And the other point I would make on top of that is to alleviate.
Sorry, just on that, you mentioned 6 billion. Going forward, do you see that as a continuing trend, or do you see things settling down once we get to clarity around the MOU, which I'll come on to, and evolution of agreements and so on?
So it's a tricky question for a number of reasons. I don't see the particular movement of shares that have left the UK returning, and I say that coming back to my point about the overarching objective of the EU, and that is to onshore financial services activity to the EU, and therefore your rules and regulations would stem from that particular objective, and therefore make it more difficult for UK entities to, you know, house EU shares on a UK venue, and therefore you have to move your ancillary business to the EU to conduct that. So I think it will be largely dependent on the rules and requirements from both the UK and the EU that would dictate what our firms need to do, and whether or not they need to move more business from the UK to the EU. I think we can commend the UK regulatory authorities and the measures that they've made in the final weeks and months, alleviating some of the stress for derivative and share trading that we would have ordinarily seen in the absence of those measures. And they've in place a number of really important.
But do you see more going outwards? You mentioned not coming back. I might have missed that.
Potentially, if you were trading EU shares with EU identification numbers of corporates, you would be required to trade them on EU venues. And I think the larger, the overall consequence of that, if this is the beginning of market fragmentation, and if you reduce optionality of firms and counterparties, and you reduce liquidity and your ability to get the best price, it doesn't necessarily mean the service can't be provided. It may well be provided from a different jurisdiction, but because you've less liquidity and optionality, it may take a little bit slower, and a little bit more time.
And how do you and your members see this in terms of the overarching numbers, both in terms of jobs and what's lost to the UK economy in relation to the financial services sector?
I think it remains to be seen. I think the movement of jobs has settled from the original numbers that were quoted maybe 18 months, 2 years ago, from 100,000 to 7,000. I think many firms actually hired organically in the EU rather than actually lift and shift EU staff. But there may be different requirements in the EU from 6, 12, 18 months from now that may require, if you have a substantial presence based in the EU, they may require you to move some of your board, further operations, further capital and liquidity. And that's what increases the costs of operating for these large institutions. And what we're beginning to see now is the beginning of market fragmentation. And if you increase the cost of doing business, it's economics 101. Where do those additional costs actually begin to land over time? And again, this increases the importance of making sure our regime here in the UK is equally attractive and competitive, and it maintains UK business.
Thank you very much. I'm going to come back to you on the MOU, but Barney, do you want to comment on this point about fragmentation and how you see things evolving? Are you do you share Connor's analysis, or do you have a very different take on this?
I do broadly. I'd add a couple of extra points. The reason that the UK is a global financial centre along with New York is because of all the synergistic benefits of the various services and products offered here, and the quality of those services and products, and their pricing and liquidity. Yep. And in fact, the capital markets shift around to where they get those benefits. And so the US drove Eurodollar business into London in the 60s through legal and regulatory measures. So as a general matter, yes, there will be an element of additional cost for service delivery into the EU, potentially depending on EU behaviours, but it largely will be a cost. It will involve incurring cost within the EU by EU businesses and consumers. And that cost ultimately will be resisted by people, because obviously people will want the cheapest services, and they will find, I think, ways around it. Now, we shouldn't stand still, obviously. We need to now remove, because the EU regulatory regime has imposed itself huge unnecessary cost on business. There are things
So I'm gonna move you on actually to the MOU in particular, because that's obviously the key opportunity through which we can try and build on the trade agreement. So can you just talk us through what you'd like to see in that MOU, which needs to be agreed by March? Barney first, and then Connor, if you can talk through what is absolutely vital for members and the wider financial services sector, and what what would be nice to have. So, I mean, obviously we've lost passporting. We're going to have to rebuild those things that are missing now in some way. Could you both reflect on those two?
Yeah. So I think what will happen anyway is that there will be arrangements for regulatory cooperation, and I believe there are good relations already between the regulators anyway. What then is in question is whether or not we can have more clarity, notice periods and so on, predictability around equivalence determinations. I suppose that's the most important thing. And there's a political tussle going on at the moment because the EU is sort of dangling those determinations and saying, well, I'll only give it if you commit to certain rules, the shape of your future regime, which I think Governor of the Bank has rightly rejected. So there's something to play out. What I layer into the analysis, though, is I mentioned Eurozone risk earlier. The UK is the only country in the world, the only place where our regulators and the Bank of England, in fact, mitigate Eurozone risk and have the expertise to do that. The EU create that risk through a whole swathe of rules, and then they don't manage it and they don't mitigate it. I don't actually think they're able to do it. The cost would be extraordinary. And so it's actually mitigated in London, where the EU market meets the global market. Now, a key part of this discussion is going to be how we mitigate that risk going forward. I actually think the cheapest and safest way to do it for the world, and the cheapest way for the EU consumers and businesses, would be through an enhanced equivalence deal. And so we should look to put back in some of the...
Do you think we're actually going to get it, or do you think that it's going to be difficult for some of the points that Connor raised?
I think we'll... Sorry?
How optimistic do you feel about that happening?
I think it's the direction of travel. I think there will be a tussle in the first instance because I don't know yet that the EU are reconciled to the gravitational forces of financial business. And so I think there'll be a period where they try and see what they can get. Now, whether they're all behind that, I don't know, because that policy driven by one or possibly two states is at the cost of businesses and consumers across the EU. So whether the other countries go along with it or not remains to be seen. It may not happen, and they may do it. And I'm actually pretty optimistic that ultimately we'll get it.
So Conor, can you just pick up on those points, because earlier George Peretz was talking about this state of constant negotiation that non-EU members have to do. Isn't that the state of our future now, even if we get the optimistic version of that future for financial services vis-a-vis the MOU?
Yeah, I mean, look, I think the relationship between the UK and the EU for financial services will continue to evolve, not only because there may be political differences between the mechanisms for market access, but actually the UK and the EU work at an international and global level as well to set standards. And if you can get it right at a global level, if you can agree generally the output and direction of travel as to how you regulate and supervise international wholesale markets, that is a fantastic start. And doing that at a UK-EU level through this regulatory framework that would be codified by the MOU would again be a fantastic start. And you end up having discussions around equivalence determinations, as opposed to having it pulled from underneath your feet at the last minute, because you've refostered trust and discussions and dialogue between regulatory authorities. You can talk about rules you are making or evolving at their conception, as opposed to doing it in two completely different contexts and then arriving at a very, very different end zone. And the result of having different rules is the more you differ, you have a higher risk or increase risk of not being able to access each other's markets because you're operating in a very, very different way. So I think you asked a moment ago about what matters for our members. I think ensuring that we are aligned to international and global standards as much as we can is incredibly important. I think the MOU isn't trivial. It's not in itself a new deal for financial services. It's simply a mechanism that codifies how regulators communicate and speak to each other. But for financial services, that's incredibly important. The final point I would make is you can delegate as much power to your regulatory authorities as possible, and they can work with each other within the powers they have been given. But both sides really need political will to want to integrate your markets, to want to work together. And this comes back to my point from a moment ago. If one party has a very different directive or objective, and that might be to move or shift business and to have less of a dependence on the UK, that's going to weigh into your ability to have a fruitful financial services relationship.
Can I just add one point on that? And I agree with all that. The extra thing to layer into that understanding is that this was going on within the EU and within the passport regime, and increasingly so. There were those who introduced the passport in order to take business from London. There have been all sorts of other attempts to take business from London. There was a constant tussle within the EU on rules. And then finally, there was the David Cameron negotiation, where there was a carve out, because the whole position of the Eurozone is an ongoing problem for the UK, as how it relates to the Eurozone and how we mitigate that risk. And that led to a sort of right to renegotiate, which was in flux. So I don't think the counterfactual is that different from where we are now. I mean, the fact is the UK, in fact, with more power, needs to recut this relationship.
Well, thank you. Thank you very much. That's really interesting. I'm very grateful.
Thanks, Rushanara.